Chainalysis Training, what you need to know about DeFi.
Oh, cool. Welcome, everyone. Welcome to this training session on what you need to know about DeFi. This is actually a session that's going to be hosted by the Chainalysis training team, so it's going to be a little bit more instructional than the other sessions that we've had. So a little bit about who we are. Well, my name's Brian. That's Adam right over there. We're part of the Chainalysis training team. We've taught regulators, law enforcement, financial institutions all over the world about crypto, compliance, and investigating crypto crime. So hopefully you enjoy this little session that we're going to have on the world of DeFi. What does our agenda look like today? First, we're going to talk about what is DeFi. What is this whole world of decentralized finance that we've heard about? What are some attributes of it? How can we access the world of DeFi? And when individuals and entities are accessing DeFi applications, what sort of applications are they accessing? We'll close with the intersection of DeFi and crime and take a look at strategies that can be taken in order to mitigate crime in the world of DeFi. So first off, our question is, what is DeFi? Well, it's an umbrella term for financial products and services that don't rely on trusted third parties, and they're often built on blockchain networks using smart contracts. So when we go and interact with traditional financial institutions, there are a lot of middlemen in place. And these middlemen might exist for a variety of purposes. Some of them might be there for customer support, KYC, custody reasons. But regardless, when we go and we interact with these traditional financial services, there are middlemen. DeFi seeks to remove these middlemen. In the world of DeFi, all of these middlemen are eliminated. And what we have is a world where all of these decentralized financial applications, they're all living on the blockchain. And anyone on the planet can go and interact with these DeFi applications. What do I mean by these DeFi applications are living on the blockchain? Well, let's zoom out for a second and go back to our idea of Bitcoin. Bitcoin's been known for decentralized value transfer. And that's this idea of I can go and send Adam 10 Bitcoin, and no one can stop that from happening. Adam's going to get that 10 Bitcoin. When we think about the world of DeFi, as I said, it lives on smart contract-enriched blockchains. And these smart contract-enriched blockchains, they go beyond the idea of decentralized value transfer and allow for decentralized computation. And all that means is you can do some more complicated steps. It allows you to do, for example, developers can go write code, and they can go and deploy that code onto blockchains. And as I said, anyone can go and interact with that code. Some common smart contract-enriched blockchains, we've got Ethereum, Phantom, Solana, Avalanche. I won't go down the list, but there's a bunch out there. So let's quickly take a look at comparing the world of traditional finance with the world of DeFi. When we think about traditional finance, well, control is limited when we're interacting with traditional financial institutions. They usually retain complete control of the assets you're going and using. So for example, you set up a trading account at something like E-Trade. Well, the stocks and shares that you have, they reside with E-Trade. On the other hand, when we think about the world of decentralized finance, it's non-custodial. So as you're going and accessing these different DeFi applications, what will happen is you retain complete control of those assets throughout the experience. When we think about the infrastructure in traditional finance, it's permissioned, right? You go to a financial institution, and they can say, sorry, we don't want to do business with you. They can turn you down. In the world of DeFi, it's permissionless. And all that means is anyone on the planet, as I said, with an internet connection can go and interact with these decentralized financial applications. So a lot of people think about this idea, they have this idea that this could potentially be great for providing financial services to traditionally underbanked communities. When we think about risk in the world of traditional finance, well, it's mitigated through legal contracts and credit risk. A lot of times you try and take out a loan, they might check your credit. If they don't like it, they might say, hey, no, we don't want to lend out anything to you. We also have legal contracts, right? If we have some sort of agreement with a variety of different counterparties, we have legal contracts in place to ensure that each counterparty holds up their end of the agreement. And we have a robust court system to ensure that if one party decides against holding up their end of the agreement, well, that can be sorted out. When we think about risk in DeFi, it's mitigated through code and collateralization. When I talk about collateralization, when you go and you try and take out some assets through some sort of DeFi lending application, typically it's going to be over-collateralized. That's how risk is going to be mitigated. When we talk about code, well, these DeFi applications, they live on public blockchains. So what you're able to do is you can go and see what the code does. You can decide, you can look for yourself and decide, hey, is this something I'm comfortable going and interacting with? When we think about liquidity in the world of traditional finance, we typically have institutional market makers, and these institutional market makers, they're typically high net worth entities that are able to go and provide market making services. In the world of DeFi, what we have is liquidity can be varied. And what I mean by varied is, well, anyone can go and provide liquidity. I can go and provide $5 worth of liquidity to a liquidity protocol and generate revenue on that liquidity I'm providing. And I can also go and provide $5 million of liquidity. And it's the same exact process regardless of who you are. It's very easy to do. When we think about security in the world of traditional finance, well, the service usually provides the security for end users. So let's say you have some sort of banking application on your phone. Well, you forget your password. Worst case scenario, you can reach out to customer support and they can help you reset your password and you'll have access to your funds. You don't just lose all your funds. When we think about, and let's say this scenario gets a little bit worse. Well, let's say someone has access to your banking application, some funds get stolen. Well, these institutions typically have measures in place to make you whole, provided that there is merit to your claim. In decentralized finance, this is completely the opposite. The users are responsible for their end security. And there's a broad range of stuff when I talk about this. So this means going and understanding how the protocols you're going and interacting with work. You have to understand how it works. Whether that means understanding the code, whether that means going and looking at the documentation and unpicking what all that means, you're responsible for doing that. And as we know, we're all responsible for custodying our funds. So that means retaining control of your private keys, your seed phrase, protecting yourself from phishing attacks, social engineering, because at the end of the day, if someone else gets access to your private keys, seed phrase, you lose your funds. So when we think about this world of DeFi and interacting with these different DeFi applications, there's a greater degree of personal responsibility associated with this world of DeFi. So now that we're talking a little bit about DeFi, let's go ahead and talk about how we go and access these different DeFi applications. So typically what will happen is, as I said a little bit earlier, developers go, they write code, and they deploy that code onto blockchains. And then anyone can go and interact with these different DeFi applications. A lot of times, what there will be is there will be user interfaces available for you to interact with that code that's on the chain. And as you can see, these UIs make it, they're really intuitive, really clean looking, and really simple to use. What typically happens is these UIs, these front ends, these websites, they're often run by centralized web servers. So they might be controlled by a single legal entity. When people bring up the idea of shutting down DeFi, let's say, oh, we should shut down DeFi, let's just take down the websites. Well, that's not really a realistic solution, and the reason that's not a realistic solution is these DeFi applications, they live on the blockchain. So even if a front end is taken down, you can still go and interact with these applications directly on your own. And we're going to actually take a look at how we can do that in a little bit. So let's take a quick look. This is the UI for Uniswap. This is a decentralized exchange. What it allows you to do is go ahead and swap one asset for another. Really simple. In only a couple clicks, you can go ahead and swap assets. So what you're able to see here is we see the UI. It says here we have some Ether. We want to swap it for a select token. You pick and choose what token you want to go ahead and swap it for. But the first thing you have to do is you have to go ahead and connect your wallet. So there's a bunch of different wallet applications out there. I like to use MetaMask. So let's say we go ahead and what we're doing here is we're connecting our wallet to MetaMask, or to Uniswap, I should say. And we hit connect after a click. And what we can see here at the top is our wallet application is now connected to the Uniswap application. We see here at the top right, 77ED is now connected to this Uniswap application. And what we're able to see is we're going to go ahead and swap 0.001 Ether for DAI. And what you can see is you punch in how much Ether you want to put. You punch in how much Ether you want to put in, and then it tells you how much DAI you're going to receive. And this is not a limit order book style exchange. This is called the automated market maker model. It's a little bit unique, but one thing you should know is, we'll keep it simple. We can talk about it later if you're interested. The idea behind this is you go ahead and you punch in what asset you want to put in, and how much and what asset you want to receive. And you punch in that particular asset, and it tells you how much you're going to receive. After that happens, you hit swap. Right after you hit swap, it'll tell you the parameters of the swap that need to be met prior to this transaction being executed. So what we can see here is 0.000123 Ether is being swapped for 0.33 DAI. We can see the USD equivalent there as well. There's some other details. We can talk real quickly about them, but it tells you the expected output. This is how much you're expected to receive after your transaction goes through. You can adjust the slippage tolerance here, and if you bump up the slippage, what you can do is it will tell you, how much the minimum you're going to receive based on your tolerance for slippage. At the very bottom, you'll see the network fee, and this is the fee that you're going to pay to the network to ensure that that transaction gets successfully mined. So after you review this, you hit confirm swap, and here, this is actually, the swap will happen shortly after, depending on your propensity for how much of a fee you want to pay, along with how congested the network might be at the time. Here we can see this is actually the UI in Reactor. This is what the swap looks like in Reactor. There's a little red box that shows you the important details. We can see here 0.000123 Ether has been swapped for DAI, where it was done. We can see who initiated the transaction and where the DAI was received at as well. You're probably wondering what's going on down below. Those are just a bunch of different smart contract interactions that are happening in order to ensure that the swap happens properly. The really cool thing about the world of DeFi is what we can see here, it's completely transparent. Anytime anyone goes and interacts with a DeFi application, it's happening on public blockchains. So there's a great degree of transparency to what is happening in the world of DeFi. So what I'm going to do now is I'm actually going to hand it off to Adam, and what we're going to do is he's actually going to show you. I walked you through how you access a DeFi application through the front-end UI. Now we're going to take a look at how we would go ahead and access these DeFi applications if the front end was taken down. So how would you do it on your own?
Great. So Brian showed us relatively quickly there that we can do a quick swap on Uniswap. And again, we're using that user-friendly interface that's often run via a centralized web server. But let's say Uniswap in their UI, maybe, and this is something that Uniswap does, maybe they are checking my wallet address, and maybe I'm an illicit actor. Maybe I'm the North Koreans. And perhaps they're not letting me swap in the Uniswap user interface. They're saying, we recognize that this is a sanctioned address. We don't want you to execute a swap using our user interface. We don't want to aid and abet this activity that we deem illicit. What can I do if I am this illicit actor? Well, if I have the technical know-how, what I can do is go directly to the blockchain. And here, we're using Etherscan as a block explorer, but if you wanted to, you could do this via command line as well. Essentially, we are going around the Uniswap user interface and interacting with a particular bit of code living on this decentralized computer. And what we can do is look for the exact function. Again, this requires a bit more technical expertise. We need to know exactly how Uniswap is functioning. But if I know what to look for, and again, this documentation, that's all out there publicly. It just requires a little bit of reading. What I can do is format my transaction. That's exactly what the Uniswap user interface was doing for us, but I'm just doing it manually. We can read the documentation, format our transaction, and the transaction we're formatting here is essentially the exact same one that Brian showed us earlier. We're swapping a small amount of Ether for the corresponding amount of DAI. It's just we have to manually specify token contracts. It's not as user-friendly, but it's still very much possible. And the output of that, once I sign that transaction using my wallet, again, I'm just going to sign it using whatever wallet application I have available, the output is the same. The outcome is the same. I have swapped my Ether for DAI, except this time, I didn't have to use any sort of user interface. I didn't get any help. It was a little bit harder, but it's still very much possible because that contract is just sitting on the blockchain. It's code running out in the open, and anyone can interact with it. And that's what we see over and over again with DeFi applications. Now, The nuances are important, and there are some protocols where the code is actually maybe not entirely decentralized, or there is governance of that code that is not entirely decentralized. But in the case of Uniswap, that code is not controlled by anyone. The actual code executing this swap cannot be changed or modified by anyone, including Uniswap Labs, oftentimes the legal entity associated with the Uniswap protocol. So what does that mean? Well, that's how we access DeFi. That's one of the key considerations when we're talking about how we interact with DeFi protocols. But decentralized exchanges, like the one that we just saw, are by no means the only protocol out there, the only typology of DeFi application out there. It's certainly the most popular, and the use case here is pretty clear, right? I have one token, I want to swap it for another. Or maybe, I have a lot of one token and a lot of another token. I want to provide some liquidity and earn some fees. Essentially, we're replicating the traditional function of a stock exchange, matching buyers and sellers, determining market price, and also we're clearing those assets. That's basically what a decentralized application does, but it's decentralized. It does so without trusting any one single counterparty, any one intermediary. And that's the theme here. We're replicating traditional products and services in a way that doesn't rely on a centralized entity sitting in the middle. When we talk about lending protocols, the idea is the same. We want to allow users to borrow and lend assets without trusting a bank or some other financial institution. How do we do that? Well, as Brian walked us through, maybe we can't rely on traditional tools like credit risk scores, but we can certainly build code, build a set of rules that allow us to lend and borrow. And in this case, it's just going to require those borrowers to put up some collateral and borrow against that collateral, so that in the case of a default by the borrower, the protocol can be made whole using that collateral that is sort of put up there. That's the goal of a decentralized lending protocol. You can think of a nice analogy that we use here is actually sort of either a reverse mortgage lender if you're from the financial industry and more familiar with that, or more practically day-to-day, a pawn shop. I put up some item of value, take out some cash against that value. If I don't repay the cash plus the interest when it is due, the pawn shop is able to take my item and sell it. That is their collateral, that's how they're being made whole, and that's essentially the logic behind these DeFi lending protocols. But what else is out there? Lending protocols, exchanges, they're very popular. There's billions and billions of dollars flowing through these protocols every day, but the world of DeFi is vast. There is a lot being built. There are a lot of new applications being built, but roughly, the idea here is oftentimes we can look at these applications and say, what traditional product or service are they replicating and trying to do so in a decentralized way? Wealth management is a nice example here. Roughly, the idea here is to replicate something like Betterment, a robo-advisor. What does a robo-advisor do? Well, maybe as an investor, I don't know exactly where to put my stocks. Maybe I can't afford the transaction fees of buying 500 different stocks. I put my money in a robo-advisor, or maybe I buy an ETF, and that entity, that it sort of allocates my funds and balances my portfolio for me. A DeFi wealth management protocol like Yearn, it can do similar things. The code has an automated strategy. Maybe it says I'm going to put 10% here, 10% here, and 80% over here. And what I can do is in one single transaction, put my money into this contract, and I know that the contract code is just going to say, great, I'm going to execute my investment strategy and allocate your funds across these various opportunities. That's a wealth management application. We can also look at a variety of other use cases here, things like derivatives, things like insurance contracts, and the goal in general is to replicate traditional products and services. We're replicating the functionality. We're enabling people to, say, take out an insurance contract against some event in the future. Maybe it's the case of travel insurance. If my flight is delayed, I would like to be paid out, but I want to do so without having to trust an insurance broker like AIG. Now, insurance brokers in general are very highly regulated, very reliable, but maybe there are advantages in terms of speed and efficiency. Maybe if I can automate this and I can just have that code running on the blockchain, looking at flight records, bringing that data on in a secure way, looking at flight records, seeing that my flight is delayed, and I know if my flight is delayed and it's reported correctly, my insurance policy is going to pay out. That's essentially the use case for a lot of DeFi applications. Replicate traditional products in a way that doesn't rely on trusting any single entity here. Now, the last point on here is stablecoins. This could be its own topic here, and there are a variety of ways of designing stablecoins. Some of them rely on trusting a custodian. Those would be the fiat currency-backed stablecoins. Others, as we have seen, maybe try and design a contract or algorithm to create a stablecoin product that tracks the value of the US dollar. That, as we've seen, can be quite challenging over the last few weeks. But we won't really get into that one. However, just it's worth being aware there are both centralized and more decentralized ways of creating that stablecoin product, that product tracking the value of traditional fiat currency. Lastly, to support all these products, we've got a whole lot of infrastructure being built under the hood. We have aggregators that make it easier to interact with many things at once. Maybe the traditional equivalent here, it's a bit more obscure, but in the foreign exchange market, you have aggregators that aggregate liquidity from various marketplaces. That's exactly what popular protocols like 1inch do. We have oracles. They would be the link, sort of in the case of that travel insurance example, they would bring on the data in a secure, decentralized way. They would bring that off-chain data about flights to let people know, let the contract know if the flight has been delayed. They bring that data on-chain, they provide that data stream, essentially acting much the way Bloomberg does for the traditional financial system, but not relying on one single source. And again, there's lots of nuance to all of these. We could spend hours and hours talking about how exactly these function, but the infrastructure is being built to support these products and services. Lastly, at the bottom here, we have all sorts of infrastructure being designed to support essentially a high-frequency trading use case, arbitrageurs who are trying to keep markets healthy, balance between various markets, and this is where stuff gets very, very technical very, very quickly. But it's worth being aware that in addition to the dedicated products and services that look a lot like traditional financial services, we also have sort of crypto-native infrastructure being built to facilitate all these other use cases on top. But great, we've covered quite a lot in a little bit of time. We definitely have some time allocated for questions at the end if anyone would like to come back to any of these categories here. But naturally, here at Chainalysis, we spend a lot of time talking about how can illicit actors use these products and services? How can illicit actors take advantage of this new and exciting ecosystem? And the first thing that, again, is worth noting, DeFi in general is used for perfectly legitimate means. It's a new technology, and people are very excited about this new technology. There's all sorts of opportunity, there's all sorts of interesting things being built, and that's the number one trend we see, is the sheer, the volume growth in the transactions flowing through DeFi applications. It is pretty staggering. If you look up graphs, there's lots of metrics, all of them are imperfect, but if you look at graphs, it's generally up and to the right. However, with this excitement, with this opportunity, comes some risk. Number one, the underlying infrastructure being built, it's new. It's not necessarily tested all the time, and therefore, clever actors have been able to steal a whole lot of money from DeFi protocols. As billions and billions of dollars have poured into DeFi protocol, we've seen upwards of $2 billion stolen from DeFi protocols in 2021. You'll see a graph in just a moment sort of comparing that to the traditional theft of cryptocurrency. But in addition to just being a target here, we also see DeFi protocols being used as part of the laundering strategy. Maybe not necessarily in obfuscation, but definitely as part of a larger strategy of how do I take these stolen funds and convert them into maybe fiat currency that I can go use to buy a car. And that's really where we're going to hone in on here for the rest of the presentation. So number one, what's the volume of, what's the scale of the problem here? Well, the graph behind me actually shows thefts of cryptocurrency from a variety of different sources here. You can see over the years, Chainalysis, this is something that we monitor very closely, and we've seen traditionally exchanges are the target. Big cryptocurrency exchanges, big centralized institutions, they're holding on to a lot of cryptocurrency. That makes them a juicy target. Sophisticated actors, including state-sponsored actors, go after these exchanges and try and make off with a lot of funds. The big change occurred in 2021. As hundreds of billions of dollars flooded into these DeFi applications, some of those applications were insecure, and people didn't really understand the risks, or oftentimes didn't care about the risks, and put a lot of money into protocols that had vulnerabilities. These same sophisticated actors, in many cases, just changed their strategy. Instead of targeting those centralized exchanges that have implemented robust cybersecurity measures and protect their private keys very, very well, they targeted these DeFi protocols and used all sorts of exploits to pull money out of these pools of funds. And the numbers we see here are pretty staggering. As you can see, it pretty much dwarfs all the other types of hacks that we're observing, and that trend has continued in the first quarter of this year as well. We've seen well over $1 billion stolen from DeFi protocols, those are the publicly attributed attacks, and we frankly expect this trend to continue into the near future. So the scale of the problem here is pretty immense, and these are real users losing funds as well. There's larger discussions on how this can be prevented, how auditing standards can improve, but what we do at Chainalysis is focus on where does this money go after? How do these funds, these billions of dollars that are stolen, how do they move through the DeFi ecosystem? And this is where we see DeFi protocols also playing a role in the laundering strategy, in the movement of funds after the fact. Behind me here, you can see the value that DeFi protocols are receiving directly from illicit addresses, the indirect exposure there, for those of you familiar with our sort of terminology here, that value is much greater. But you can also see that the illicit share of all transactions, that percentage is creeping up. So these massive protocol thefts have resulted in a greater proportion of all DeFi transactions being related to illicit activity. Now that percentage is still very small. You can see on the graph, it's below 0.3%. However, it is a trend that we are obviously very aware of, and one that we'll be keeping an eye on in the future, seeing how these illicit actors continue to use DeFi protocols as part of their laundering strategies. However, one note about DeFi protocols is that they are not mixers. Now, there are specifically built mixers on Ethereum, and Tornado Cash is obviously very well known. But in general, when we're talking about DeFi protocols, when we're talking about decentralized exchanges, when we're talking about lending protocols, they're not trying to hide where the funds are going. They might be complex, they might result in complex transactions like Brian showed us earlier, but fundamentally, everything is out there in the open. All the interactions here are recorded on the public blockchain. That's because these protocols are just contracts. It's code running out in the open on these global computers. Therefore, if we're able to parse through complexity, we can say what's going in and what's coming out. While we can't stop these illicit actors from using a DEX, as we just saw, I can go directly to the blockchain. If I know what to look for, or if I have a nice way to hone in on what really matters, I can say what tokens went in, what tokens went out, or how is my illicit actor using this decentralized lending protocol? How is my illicit actor using this wealth management protocol? What is their goal here? What is the economic interaction that is occurring? Therefore, although we see criminals using DeFi protocols, it's not necessarily an obfuscation method on its own. It's certainly been used as such, but I would argue it's not a good long-term strategy because essentially that trail is there forever. It's recorded on the blockchain, it's recorded on the public ledger, and we just need to focus on what really matters and try and determine what went in and what went out. Now, lastly, I will say in terms of DeFi compliance, what can be done or what is being tried? Well, there's a lot of experimentation here. But one way that we're trying to do our part is providing data on-chain as well. What we've done, or at least our first step in this approach, is the creation of the Chainalysis Sanctions Oracle. This was announced very publicly. Essentially, what this is, on-chain, is a contract that lists all sanctioned addresses by the US, EU, and UN. Now, we've coded this Oracle in a way where we can update it with new additions to the sanction list, but essentially, there is now an on-chain source of data that can be used either by user interfaces or potentially by contracts themselves to check if an address has been sanctioned or not. Now again, this is clearly only the starting point, but that data is now publicly available on a variety of different smart contract-enabled blockchains, and we'll continue to work with the DeFi industry to see what can be done there. However, rather than continue talking, I'll have Brian come back up on the stage here, and we can open the floor for questions. Thanks so much, everyone, for hearing out our presentation, and definitely let us know what you're curious about.
I was wondering if you had much luck with the mixers that are in DeFi, like Tornado Cash, which is like right on Polygon and right on ETH. Because I know you've had some success with mixers, like on Bitcoin, but without giving any details, like have you had any success there?
Yeah, in general, we don't really publicly discuss sort of our capabilities around specific mixers, but in general, step number one is always attributing that mixer correctly, and that's something that you've seen in other presentations where a big focus right now is letting people know the extent of the mixer, which is a bit easier when it comes to Tornado Cash, but at least, we can provide investigators, here is the extent of the mixer, don't try to trace through it, and then, later on in particular cases, maybe we can help.
Thank you so much for the presentation. Brian, you had mentioned specifying the amount of slippage on the Uniswap. I was wondering if you could define that term.
Yeah, so slippage is like basically your willingness for, so how much of a price change you're willing to tolerate. So let's say there's a ton of people on the planet trading. Let's say we have this asset. Let's say Ether is trading at 2,000 bucks. What happens is, let's say a ton of people decide to buy Ether all at the same time. The price of Ether is going to go up. You can submit in your, in the details of your trade, your tolerance for how willing you are for the price of Ether to go up, or how high of a price of Ether you're willing to tolerate in order for that swap to be executed. So let's say a ton of people buy Ether. Your slippage tolerance is set really high up. Well, that transaction might still go through. But this is also like a method that's designed to protect users. So you want to leave your slippage typically pretty low because you don't want to end up paying much more than you expected for a particular asset. So that's really how slippage works. Yeah.
Hi, my name is Carl. How safe are flash loans given the short time they are open? Can fewer things go wrong or more?
Yeah, flash loans are really interesting. For those of you who are not aware, a flash loan is essentially the idea is that funds can be loaned out without really counterparty risk if they are returned in the same transaction. And that's something that's actually not really possible in traditional financial services, right? This transaction will only occur, it will only successfully execute if the funds are returned at the end. So I can lend out funds risk-free in this transaction as long as they come back at the end because there's no possibility of the entity making off with my funds. So from that perspective, flash loans, if built properly into the contract, are very safe. However, what we've seen is people take advantage of this ability to source hundreds of millions of dollars of liquidity or funds in a single transaction to execute certain types of attacks on DeFi protocols, maybe manipulate the price in a way that wasn't intended, and then use that to extract money from the protocol. Again, that's a particular type of attack, often manipulating a price feed, but that's where we see flash loans being used illicitly, but the flash loans themselves, there's really nothing inherently malicious about that, and they can also be very convenient to, say, rebalance a financial position without having to take out a loan from a traditional financial institution. All right. I'm not seeing any more questions. All right, in that case, we can end early. Thanks so much, everyone.
Well, thank you.
Thank you so much.